Welcome back to Finance Hub UK. The UK pension system is once again facing a major shake-up, and this time the warning comes directly from HMRC. Recent reports have confirmed that a £300 deduction linked to savings, tax adjustments, and bank handling could soon hit pensioners, particularly those who are already struggling with rising living costs. For millions who rely on their state pension as their main or only source of income, even a few pounds being deducted can feel like a heavy blow. But when the figure being discussed is £300 or more, it raises urgent questions about fairness, timing, and whether older people are being forced to shoulder the burden of economic pressures they didn't create. In this extended breakdown, we'll take you through everything you need to know: the background of HMRC's move, which groups of pensioners are most at risk, how savings thresholds are tied into this new rule, and why banks are playing a critical role in the deductions process. We'll also explore how these changes intersect with wider pension reforms, the warnings being sounded by campaigners, and what practical steps you can take to safeguard your money. If you're a pensioner, close to retirement, or supporting an elderly family member, this could be one of the most important updates you'll hear this year. Why HMRC is targeting pensioners in 2025. The first question on everyone's mind is why now? HMRC has justified the move as a necessary step to balance discrepancies in pension tax relief and to ensure people with higher savings or multiple income sources contribute fairly under the current tax code. However, critics argue that the system is unnecessarily complicated and disproportionately punishes older people who have done the right thing by saving. HMRC links deductions to uncollected tax from past years. Pensioners with multiple income streams, e.g. part-time work plus pension, most at risk. £300 figure represents an average adjustment but can be higher for some. Critics warn HMRC is quietly tightening rules without transparency. The £300 deduction explained. So what exactly is this £300 deduction? HMRC has flagged it as an automatic bank adjustment, where money owed in tax or recalculated pension liabilities can be taken directly from accounts. This happens through a process known as direct recovery of debt, DRD, where banks cooperate with HMRC to recover funds. For pensioners, the alarming part is the lack of control. Many report only learning about deductions after they've happened, leaving them scrambling to cover bills. In 2025, the new rules suggest these adjustments could become more frequent, particularly as HMRC ramps up checks on pension-related income. Automatic bank deductions mean pensioners have no say in timing. £300 is an average, deductions could be smaller or much larger. Banks will be legally required to comply under HMRC's request. Pensioners fear it could hit just before key payments like rent or utilities. Who is most at risk? Not every pensioner will be affected in the same way. HMRC has clarified that only certain groups are likely to see deductions, but these groups are large enough to cause widespread alarm. Pensioners with savings above £10,000 in banks may be more closely monitored, those still working part-time alongside pensions. Anyone receiving a private or occupational pension in addition to state pension. Households claiming certain benefits where overpayments are suspected. This creates a double worry. Pensioners are being told to save responsibly for retirement, but once they do, their savings become a target for deductions. The role of banks in enforcing deductions. Banks are no longer just passive players. Under the 2025 rules, they are active partners with HMRC in enforcing deductions. This raises major trust issues, as pensioners rely on banks to protect their money, not hand it over. Banks will receive direct instructions from HMRC to release funds. Customers may not receive prior notice before deductions occur. Critics argue this undermines confidence in UK's banking system. Pensioners fear losing independence over their own money. Wider pension reforms in 2025. The £300 deduction doesn't come in isolation. It's part of a broader set of pension reforms the government is introducing this year, including tighter eligibility checks for benefits, adjustments to state pension age, and stricter rules around property ownership for pensioners. The deduction is one piece of a larger puzzle, and campaigners warn it's a slippery slope toward further automatic deductions. Rising state pension age already putting pressure on retirees. Cost of living crisis worsens impact of any deductions. Pension fairness reviews being criticized as disguised cuts. Fear that £300 deduction could lead to larger recurring amounts. Real-life impact on pensioners. To understand the true scale of the issue, it's important to hear how these deductions play out in reality. Many pensioners live on fixed incomes, budgeting carefully month to month. A sudden £300 loss can mean choosing between heating and groceries, falling behind on rent or council tax, having to borrow money, leading to debt traps, emotional stress and a sense of financial insecurity. Campaign groups argue that HMRC fails to understand just how fragile household budgets are for many older people. What HMRC isn't telling you. One of the biggest criticisms is the lack of transparency. While HMRC says deductions are necessary, they don't openly explain that pensioners can sometimes challenge or appeal them. Most pensioners simply don't know their rights. Few pensioners are aware they can request repayment plans. Deductions may include interest and penalty charges. HMRC communications often use technical jargon that confuses recipients. Critics say this lack of clarity is deliberate to discourage challenges. How to protect yourself. So what can pensioners do to avoid being blindsided by these deductions? Financial experts suggest several proactive steps. Regularly check HMRC tax codes to avoid hidden underpayments. Keep savings spread across accounts to limit large single deductions. Seek advice from pension advisory services before making withdrawals. Challenge HMRC if you believe deductions are unfair or miscalculated. Being informed is the first line of defense against unexpected deductions. Campaigners' demands. Campaign groups, charities, and MPs are starting to push back against these new powers. They argue pensioners are being unfairly targeted to cover shortfalls in the tax system. Demands for an independent review of HMRC's deduction powers. Calls for pensioners to be exempt from direct recovery rules. Warnings that trust in both HMRC and UK banks is collapsing. Proposals to introduce a minimum protection threshold to safeguard savings. What the future could look like. If the £300 deductions go ahead unchecked, experts warn this could just be the beginning. In future, deductions might expand to cover council tax arrears, energy debts, or benefit overpayments, all enforced directly through banks. This creates a worrying precedent where pensioners have less control over their own money. Could expand into other deductions beyond pensions. Risks discouraging people from saving for retirement. May push pensioners to withdraw savings early to avoid deductions. Long-term damage to trust between public and government institutions. The HMRC confirmed £300 bank deduction is more than just a financial adjustment, it's a signal of how much control pensioners risk losing over their money. While the government frames it as necessary, the lack of transparency, the involvement of banks, and the pressure on older people paint a worrying picture. Pensioners should stay informed, check their tax codes, and be prepared to challenge deductions when necessary. The coming months will be crucial in determining whether this policy becomes just another burden or whether public pushback forces change. If you're worried about these HMRC changes or want to know whether you're at risk of the £300 deduction, make sure you stay subscribed. We'll keep bringing you the latest pension updates, government decisions, and money-saving advice. Don't forget to like this video, share it with someone who needs to hear this, and leave a comment below with your thoughts. Do you think HMRC is being fair, or is this just another way to take from those who can least afford it?